few months earlier, Grow.in had recently published an article on the top 3 pharma sector stocks of India. Companies like Sun Pharma, Divi Labs and Cipla Limited were given an honorable mention in this article. Fast forward to the second week of March 2023, the pharma sector began to collapse, including the Nifty Pharma Index and the stocks mentioned by Grow.in earlier. Now, from an investor's point, this can be the right time to make an entry into the stock. As it goes, buy low, sell high. We'll use tickertape premium for our analysis and find out, will these pharma stocks make us rich or leave us in a ditch? Disclaimer: this is not a stock buying recommendation. This video is solely made to perform fundamental analysis. Your money, your responsibility. Number 1. Cipla Limited. The company started off its operations in 1935 in Mumbai by a Muslim advocate, Khwaja Abdul Hamid. Fast forward to the year 1985, now the company's CEO is the advocate's son, and in the same exact year, the company gets approval from FDA of the United States to expand its business operations to another continent as HIV/AIDS was swinging swords on the neck of the Americans. Now, as of 2023, Cipla Limited is now widespread in 49 countries and is India's third largest drug manufacturer. This was all about the background. Let's hear what story do the numbers have to say. Beginning with the stock's 1-year return, we can see the stock price is going straight down, which is the case with every other pharma stock. However, despite the 1-year loss, we can still see a 53% growth in its stock price on a 5-year scale, which isn't really bad for a reasonably large cap company. Moving to the financials tab, we can see how the tool already tells us how there's a great revenue growth and net income. The market share is almost the same. Let's leave that. Moving a bit down, comparing the data of the past 4 years, we can see how there's a 5,000 crore rupee increase in total revenue and nearly double net income yield since FY 2020. EPS also tells a good story, which is also a good sign of growth. In the forecast section, we can find how almost 3/4 of investors recommended buying and holding this stock. This section also predicts the highest, median, and lowest price projection, which you can also see on this screen. Number 2. Sun Pharma. According to Wikipedia, Sun Pharmaceuticals is a big name in the medical field. Established in 1983, the company is now almost 40 years old. Sun Pharma's portfolio consists of medicines like Pharyngosept, Revital, and Volini, though they make more than 72% of their sales from selling pharmaceutical formulations and ingredients in their global market of more than 100 countries across the globe. Let's dive into some financial metrics. The stock can be found by the ticker Sun Pharma. The stock's 1-year return is around 7%. Its 5-year returns are around 84 to 83%, which translates to almost 16% CAGR. Though the stock seems to be a bit overvalued, but that usually indicates that there are high hopes for further growth from the investor's side. We can clearly see a relatively low revenue growth compared to its competitors, which is justifiable as there isn't much room for further growth. A slight decrease in the market share, a bit less profitable than its competitors. Moving a bit low, the company has witnessed a decent increment in its total revenue and net income in the past 3 years, which is again a sign of growth and stability. Earnings per share and dividend given per share also reflects a sign of consistent growth. Number 3. Divi Laboratories Limited. Traded under the ticker Divi's Lab for the National Stock Exchange, Divi Laboratories is a global exporter of active pharmaceutical ingredients established in 1990. They do not directly sell over-the-counter medicines. Instead, they sell key drug ingredients for big pharma companies around the globe to use in their products. It's like being an outsourcing destination for pharma companies who do not want to make their medicines from scratch. The stock price has also plummeted to almost its 52-week lowest, or in other words, taking the company a year backward in terms of share price and market cap. Let's see their income statement from a growth view model. Down here, we can see that their income statement seems to be severely damaged due to an unexpected drop in pharma sales from the global markets as mentioned in the beginning. Total revenue is down 4.45% after a consecutive high growth in the past 3 years. Net income is also down 19% after a constant 40% increment in the past 2 years, and so is the EPS. Overall, the company has great growth potential, but its high dependency on the global markets caused jet lag in its finances. In the end, investing with patience is the only way to make the most profits, and think of building a steady source of income before thinking of building a portfolio. And before leaving, let us know what sector shall we cover next? The bank sector, or how about tech stocks? Also, we've posted a video on the psychology of money. Go check it out ASAP. Till then, Omega Finance signing out.